Question 14 is another capital gains style question, but this time there's quite a lot going on. So the start of the question gives us a reminder of some tax rules relating to capital losses, and says in this case we're going to work on the basis that capital losses arising within the year must be offset against capital gains arising in the same year before then being carried forward to offset against first available gains in the future, which is the general rule that we use with capital losses in the Cima exams. So in this case it tells us that during the year to 30th of 2004 we've made two disposals, one of which gives us a capital gain, one gives us a capital loss, and then in the next year to 2005 they've sold an asset for 90,000 and gives us all the details about the purchase and any improvements to that asset. What the question actually wants us to do then is take some of these options that we've been given and drag them into the boxes underneath to show how much tax would actually be due for each of the 2 years, assuming a tax rate of 20% and the use of no annual exemptions. So in the real exam, this would be an example of a drag and drop style question where you would use your mouse to highlight one of these answer options and actually drag it down into the right place. For now, let's just work through how we get to the answer then. So 2004, we have two disposals, one giving us a gain of 15,000, the other giving us a loss of 18,000. Within the same year, we said capital losses must be offset, and so in actual fact, there would be no gains left over to charge in 2004, which must result in a nil tax figure. What it does do is leave us with some losses to carry forward of the remaining $3,000. We then go ahead to the 2005 year, and this time we actually need to calculate our gain. So in order to do that, we would start off with those disposal proceeds of $90,000, deduct the original cost of $30,000, and then go and think about any enhancement expenditure. In this case, it tells us we've paid some maintenance costs in 2003 of $5,000. But this isn't any kind of improvement of the asset. This is just maintaining it. And so this would have been a revenue cost written off at that point. We don't take account of that here in the capital gain calculation. Whereas in 2004, there is some enhancement expenditure. That's some kind of improvement. So yes, we would deduct that $10,000 cost. Initially then, that gives us a gain of 50,000, but we haven't quite finished because we need to go and think about the effect of indexation allowances using the indexation factors. So in this case, in 2003, this is when we've spent $30,000, and so our indexation on that would be at this given rate of 40%, giving us indexation to deduct of 12,000. In 2004, this is where our other cost comes in of $10,000, and we would use this 28% rate to give us further indexation to claim of another 2,800. So in total, we're able to reduce this gain here by indexation allowances of 12,800, which means that we get a gain of 35,200. But remember that the rules on our losses were that we would carry forward any unused losses, that's this loss here, and match it up with the next gain which arises. Well, this is our next gain arising. So we're left with 32,200 of chargeable gains in this 2005 year. So those $32,200 of gains would be taxed at the relevant rate of 20% and would mean that we end up with a capital gains liability of $6,440 in 2005. So in terms of our actual answers, the correct ones to drag into these boxes would have been nil for 2004 and 6,440 for 2005.